There are moments in markets that you never forget. And February 12th, 2026 was one of those moments. If you were sitting in front of your screen that morning, you watched something happen that most people in the financial world had told you was basically impossible. Gold, the metal that had been climbing to heights nobody had ever seen before, the metal that had turned ordinary investors into millionaires on paper, collapsed $700 in 30 minutes. Not 30 days, not 30 hours, 30 minutes. And silver, which had been the darling of retail traders for months, fell 10% in a single session. People were refreshing their screens thinking there was a glitch. There wasn't. This was real. And if you didn't understand why it happened, you almost certainly made the wrong move right after it did. If this kind of deep dive breakdown is what you've been looking for, hit that subscribe button right now and tap the bell so you never miss a video like this one here on Element Axis. We go where the real analysis is. No noise, no hype, just the stuff that actually matters when markets move in ways that shake people to their core. And this one shook a lot of people. Now, before we get into the mechanics of what caused this crash, let me say something clearly. If you lost money in this event, or if you're sitting there right now not sure whether to hold, sell, or buy more, you are not alone. Some very experienced, very intelligent traders got caught in this, and the reason they got caught isn't because they were stupid. It's because the signals that warned this was coming weren't on the front page of any newspaper. They were hiding in places most people don't even know to look. By the time you finish this video, you'll know exactly where those signals were, what they were telling the market, and what you should be watching right now. So let's take this from the beginning, because the story didn't start on February 12th. That was just the day the pressure finally gave way. Gold had been on a run that felt almost unreal. Prices climbed from the mid-4,000s all the way up to $5,627 per ounce. That's a move that made the news, filled social media feeds, and brought in a whole new wave of buyers who had been sitting on the sidelines and finally decided to jump in near the top. And that's always how it goes. The late money comes in during the final phase of a parabolic run. The people who've been in for years are the ones taking profits, while the newer money is buying with confidence and sometimes with borrowed leverage. That dynamic is as old as markets themselves. And what it creates is a very specific kind of fragility that looks perfectly fine right up until the moment it isn't. The first crack didn't come on February 12th. It came earlier, on January 30th, when Kevin Warsh was nominated as the next chair of the Federal Reserve. Warsh has a reputation for being significantly more hawkish than the current Fed leadership. Hawkish in Fed language means he leans toward keeping interest rates higher, fighting inflation more aggressively, not cutting rates quickly. And the moment that nomination was announced, experienced market watchers started quietly adjusting their positions. Not in a panic, but in the way that traders do when they see the rules of the game about to change. Here's why that matters so much for gold specifically. Gold pays you nothing to hold it. No dividends, no interest, no coupons. When rates are low, the cost of holding gold is minimal. But when rates are high, every dollar sitting in gold is a dollar that could be earning meaningful yield somewhere else. Higher for longer rates are a real headwind for gold. The Warsh nomination was the market's first signal that the interest rate environment was shifting in a direction that wasn't gold-friendly. You didn't see panic after January 30th. You saw something quieter and more dangerous. Momentum started to slow, the dollar began to strengthen. Some of the earlier investors started reducing their exposure. Nothing dramatic, just a gradual rotation of the smart money toward the exits, while the late money was still buying. And the stage was being set for what would happen roughly 2 weeks later. Now let me walk you through the actual mechanics of what happened on February 12th, because this is where most people's understanding breaks down. They see a crash and immediately think something fundamental changed. That emotional reaction leads them to make decisions based on a misunderstanding of what actually happened. Bear with me here because this is a little technical, but it will completely change how you see events like this. When traders buy gold or silver futures, they don't pay the full value of the contract up front. They post what's called margin, a deposit that lets them control a much larger position than they could otherwise afford. This is leverage, and leverage is a tool that works in both directions with equal force. What it does on the way up, amplifying gains dramatically, it does on the way down with the same amplification of losses. Leading into the crash, an enormous number of traders were using leverage to be long silver and gold. The speculative positioning had become historically extreme. Here's where the CME Group comes in. The CME is the exchange where gold and silver futures trade in the United States. In early February, they overhauled how margin requirements work for silver, moving to a floating system where the margin required is calculated as 18% of the notional value of the contract. That sounds like a small technical change, but the practical impact was enormous. When silver's price started declining, the amount of margin traders needed to post went up in real terms. And when prices fell fast, the system started generating margin calls at a speed traders simply couldn't keep up with. A margin call is a notice from your broker that your deposit is no longer sufficient to cover your risk. You either put in more money immediately or your position gets closed. And when thousands of traders across the country are receiving these notices at the same time, what happens next is mechanical and brutal. They sell. Not because they change their view on silver, not because they think silver is a bad investment. They sell because their broker is literally forcing them to. And that selling drops the price further, which triggers more margin calls, which forces more selling, which drops the price further still. It's a feedback loop that feeds on itself and creates moves that look completely disconnected from any fundamental reality because they are. This is what traders call a liquidation cascade. And once it starts with enough momentum, it's like a fire that has to burn through all the available fuel before it stops. The fuel in this case was the leveraged long positions built up during months of parabolic price action. On February 12th and 13th, that fuel burned. Drop a comment right now. Before this crash happened, were you aware that the CME could change margin rules like this? The number of investors who never think about margin mechanics until they're on the wrong side of a margin call is staggering. Understanding this separates experienced participants from people who get repeatedly blindsided by events that follow a predictable pattern. And while you're down there, hit the like button if this breakdown is adding to your understanding, because it genuinely helps more people find this content. But even if you knew about margin mechanics, there was still a signal that most people missed, and this signal was arguably the most important one. It came from Shanghai. And if you weren't watching it, you had no real warning that the physical floor under gold was about to disappear. For months, leading into the crash, the Shanghai Gold Exchange had been trading at a significant premium to the prices you'd see on Western exchanges like COMEX in New York. At the peak, Shanghai Gold was trading $72 per ounce above the COMEX price. Buyers in China, the world's largest physical gold market, were willing to pay a meaningful premium above the global benchmark just to get their hands on physical metal. And when the world's biggest buyer is paying a premium, that creates a floor under global prices. The physical demand is real, substantial, and it provides a base that purely speculative moves in paper markets can't easily break through. That premium was what gold bulls were counting on. Yes, prices were elevated. Yes, there were speculative excesses. But as long as Chinese buyers were paying above market to accumulate physical gold, there was a real-world backstop. The paper prices weren't just floating in air. They were connected to genuine physical buying from one of the most consequential economies on the planet. And then, in early February, the premium disappeared. And not just disappeared, it flipped. Shanghai Gold went from trading at a $72 premium over COMEX to trading at a $14 discount. The market went from Chinese buyers paying $72, more than the global price to get physical gold, to a situation where Shanghai Gold was actually cheaper than what you'd pay in New York. That's a swing of $86. In the relationship between the two most important gold markets in the world. In terms of market signals, this was the equivalent of a fire alarm going off in a crowded building. Loud, clear, and most people weren't paying attention to it. What this flip told you was that the physical demand supporting the rally was gone. Chinese buyers who had been relentless accumulators were either satisfied with their positions, facing their own economic pressures, or simply not willing to pay premiums anymore. Whatever the reason, the floor was gone. And once you remove the physical floor from a market running on speculative leverage, you're left with a structure that has no real support underneath it. All it needed was a trigger, and the trigger came. Think of it this way. Imagine a building where the foundation is solid and the structure is well built. Now imagine someone quietly removes sections of the foundation in the dark. The building still looks the same from the outside. Nothing visible has changed, but its ability to support weight has been fundamentally compromised. The Shanghai flip was the removal of the foundation. The margin call cascade was the weight that finally caused the structure to give way. Now, let's talk about what happened to the mining stocks, because the miners showed you what real volatility looks like. The world's largest gold mining company saw its shares fall roughly 15% from the January peak. Its all-in sustaining costs are well below where gold is trading. Nothing about the fundamental business changed in those 30 minutes on February 12th. What changed was sentiment and institutional capital positioning. When fear takes over, institutional funds don't evaluate each stock individually. They hit the sell button and reduce exposure to the entire sector. That's how a perfectly healthy, profitable business loses 15% of its market value in days when the underlying commodity corrects sharply. Another major gold producer with significant copper exposure lost close to 13% of its market cap. The copper exposure made it doubly sensitive to this particular correction because the forces driving gold lower, a stronger dollar, a hawkish Fed outlook, tighter global liquidity, were also weighing on copper simultaneously. The real devastation was in the silver mining space. Companies that are high beta producers experienced what observers described as violent and indiscriminate selling. When silver drops 10% in a day, a silver mining stock doesn't drop 10%. It can drop 20, 25, even 30% because of operating leverage. If a miner produces silver at $60 per ounce all-in cost and silver drops from $120 to $108, their per ounce profit didn't drop 10%. It dropped from $60 to $48, a 20% decline in profitability. That's why the stocks move more violently than the metal, and it's why position sizing in the mining sector requires a very different mindset. Now, let's talk about the technical picture, because there were signs in the charts for anyone watching carefully. In the final weeks of the gold rally, the relative strength index hit a peak of 90. RSI measures momentum on a scale from 0 to 100. Readings above 70 are considered overbought. Readings above 90 are historically associated with imminent and often sharp reversals. They're rare, and they tell you the market is running on fumes. But here's the part that was even more telling. In the final leg of the gold rally, as prices were making new all-time highs, the RSI was actually trending downward. The technical term for this is bearish divergence. Price going up while momentum indicators go down. It's one of the most reliable warning signs that a rally is near its end. What bearish divergence tells you is that each successive high is being achieved with less buying pressure than the previous one. It's like pushing a car uphill. For a while you can maintain speed, but the effort required keeps increasing. Eventually the engine gives out. When you combine the RSI divergence with the Shanghai premium flip, with the margin rule changes, with the hawkish Fed signal, what you have is a confluence of warning signs that each individually might be dismissible, but together paint a picture that should have prompted serious risk management. No single indicator tells you the whole story, but when multiple independent signals start pointing in the same direction, that's when you need to take it seriously enough to act. Share this with someone who trades precious metals or was caught off guard by this crash. The analysis here might help someone avoid a bad decision when emotions are still raw. Drop the link in your group chat or send it to a friend. Let's put this crash in historical context, because there are two previous episodes in precious metals history that rhyme with what just happened and should inform how you think about what comes next. The first parallel is 1980. Paul Volcker had just taken over as Federal Reserve Chair with one mission: break inflation. Gold and silver, which had been in massive bull markets driven by inflation fears throughout the late 1970s, crashed hard as the new monetary regime made clear it meant business. The nomination of a more hawkish Fed chair today signals a potential shift in the monetary environment. In 1980, that kind of regime shift was enough to break the momentum of a parabolic precious metals rally. The market in 2026 is reacting to a similar kind of signal. The second parallel is 2011. That was the year silver approached $50 before collapsing dramatically. The trigger? The CME raised margin requirements multiple times in rapid succession. What we saw in 2026 echoes exactly what happened 15 years earlier. Both times, the exchange changed the rules on traders who were already positioned. Both times, it triggered a liquidation cascade that swept away months of gains in days. Now let's address the de-dollarization trade, because it's been central to the discussion since the crash. For years, one of the strongest arguments for gold has been that central banks are diversifying away from the US dollar. That's genuinely true, and it provided real, legitimate underpinning for the bull case. But here's the thing about trades that become consensus. When everyone is positioned the same way, you don't need a fundamental change to trigger a reversal. You just need a change in confidence. In a crowded trade, when selling starts, there aren't enough buyers on the other side to absorb it gracefully. And far enough sometimes turns into devastatingly far. The dollar strength in 2026, with the DXY pushing toward 100, signals that global liquidity is tightening faster than markets anticipated. And here's something counterintuitive but absolutely real. When liquidity gets truly tight and the hunt for cash becomes desperate, even safe haven assets get sold, even gold. When you need cash urgently, you sell what you can, not what you want to sell. This is why gold can fall sharply during genuine financial stress. Let's talk about what you should actually be watching going forward. I'll be upfront with you. I don't know for certain whether the bull market in precious metals is over. Nobody does. Anyone telling you with absolute certainty what happens next is performing confidence, not demonstrating knowledge. But here's a framework for evaluating what's happening as it unfolds. Watch the Shanghai premium first. If the discount stabilizes and starts moving back toward neutral or premium territory, that suggests physical demand from China is returning and the floor is being rebuilt. But if the discount persists or widens, the correction may have further to run. Watch the gold-silver ratio second. Silver tends to lead gold to the downside in corrections and often leads it to the upside in recoveries. When the ratio moves dramatically, something more specific is usually happening beneath the surface. Watch Federal Reserve communication third. Any signal that the hawkish impulse is moderating would be supportive of precious metals. Higher rates for longer maintains the headwind. Watch not just what Fed officials say formally, but how markets react to it. The reaction can tell you more than the words themselves. If you survive the crash without getting completely stopped out, take a breath. The overleveraged traders have largely sold. The margin calls have largely gone out. What's left are people with conviction, manageable position sizes, or who are evaluating fresh entry points. That reset is actually necessary for a bull market to restart. The correction, painful as it is, clears the excess and creates a more sustainable base. If gold breaks below 4,900 with conviction, that changes the analysis, not necessarily meaning the bull market is over, but suggesting the correction needs a lower equilibrium before stabilizing. For silver, the $75 to $76 range is where the market is trying to find a floor. Whether it holds or breaks will tell you a lot about buying interest here. If you were stopped out or took significant losses, resist the urge to jump back in out of fear of missing the recovery. The market will give you another chance, but only if you're still in the game. The worst thing you can do is let the emotional aftermath push you into a revenge trade that compounds the damage. The flash crash created what you might call a forced discount in mining stocks. Companies that were trading at premium valuations weeks ago are now available at significantly lower prices. In the mining world, downturns that push smaller producers into difficulty often lead to consolidation. The big players see acquisition opportunities in distressed mid-tier valuations. But for individual investors, selectivity matters more than ever right now. Focus on companies with strong balance sheets, reasonable debt, and cost structures that remain profitable at lower metal prices. The junior explorers and high-leverage producers face real existential questions if this correction extends. Let me address one more important thing before we close, and that's the lesson about narratives. Before the crash, there was a story about gold and silver that felt almost airtight. Central banks accumulating, de-dollarization accelerating, physical supply constrained, industrial silver demand growing. It all contributed to a narrative that felt not just compelling, but inevitable. Gold to 6,000, silver to 200. The future already written. That's exactly the danger of a compelling narrative. When a story about why an asset should go up becomes widely accepted, it attracts capital that is simply following the consensus. And the feedback loop between narrative and price works in both directions. When the narrative cracks, even slightly, the same dynamic runs in reverse. The best protection is to never stop asking the question nobody in the excited crowd wants to ask. What would have to be true for this to be wrong? If you can't articulate a realistic bear case for an investment you hold, that's a warning sign. The traders who navigated this crash best were the ones who held their convictions loosely enough to reduce risk when the signals started changing. If you had exposure going into the crash, did you have conditions defined in advance where your thesis needed to be reevaluated? Because if you didn't, that's the real homework, not finding the next trade. The homework is defining in advance the conditions that would change your mind. The market will test your conviction again. It always does. Having that framework ready before the test comes is the difference between a disciplined decision and an emotional one. And for investors in the 45 to 60 range, which describes a lot of people watching this, these aren't just numbers on a screen. This is retirement savings, money that took decades to accumulate. Losses feel approximately twice as painful as equivalent gains feel good, and that asymmetry pushes investors toward decisions they would never make with a clear head. The antidote is having made your key decisions before the emotional storm hit. If you decided in advance how much to allocate and set clear stop-loss levels, then when the crash comes, you're executing a plan you already made. You're following a system you built when you were calm. That's the infrastructure that separates people who build wealth over time from people who repeatedly buy high and sell low. So here are the clearest takeaways. The Shanghai Premium was the most important early warning sign that most people missed. It told you the physical demand floor was weakening before the paper markets crashed. If you weren't watching it before, start watching it now. It is one of the most reliable indicators of genuine physical buying from the world's largest gold accumulator. Leverage is the accelerant that turns corrections into crashes. The margin mechanics we covered are a built-in feature of how futures markets work. When you choose to use leverage, you're accepting the possibility of a margin call in a fast-moving market. Understand that consequence clearly before you make the choice. No single indicator tells the complete story. RSI divergence alone wasn't the story. The Shanghai flip alone wasn't the story. The margin changes alone weren't the story. But together, they were telling you something that needed to be heard and acted on. Narrative discipline is non-negotiable. The gold and silver story was compelling and had real underpinning, but it became overextended. The price got so far ahead of what actual physical buying could support that any disruption to speculative positioning was going to cause a significant correction. Holding your thesis loosely enough to respond to changing evidence isn't weakness. It's how you survive long enough to play the next round. And finally, this may not be the end of the bull market. It may be a reset, A painful, brutal reset that shakes out excess and creates a better foundation for the next leg higher. But that depends on whether support levels hold, whether physical demand from China returns, and whether the Fed environment evolves in a way that's less hostile to real assets. None of that is guaranteed. All of it is worth watching carefully. Tell me in the comments how you came through this event. Were you positioned in gold, silver, or the miners? Did you take losses? Did you see any of these signals coming? Share that below. The experiences of this community sharpen the analysis, and I genuinely read what you write down there. If you're not already subscribed to Element Axis, do that now and hit the bell. Share this with at least one person who would benefit from this breakdown. Clear thinking during moments like this can genuinely protect someone from making an expensive mistake. Stay patient, stay disciplined, keep your position sizing honest. The investors who come out of events like this in the best shape are rarely the ones who made the most aggressive moves. They're the ones who stayed grounded, managed their risk carefully, and had the patience to wait for clarity before committing new capital. The market will give you more opportunities. It always does. The goal is to still be standing when those opportunities arrive. We'll see you in the next one.